So life happens. We can't make our payments or contributions into the life insurance policy anymore. What's going to happen? Well, if everything was set up properly, meaning we designed the policy right and we stuck with one of the top companies, we'll be fine. And our cash value can continue to appreciate in the present dividend environment and also even in a guaranteed rate environment, which we're going to look at some examples. But if it wasn't set up right, that's where we can get into trouble. So what we're going to look at here is, let's assume we had an original plan to fund the policy for a long time. Long time depends on your scenario. It could be 10, 20 years to a certain age, or maybe we wanted to pay into the policy forever. So that was the plan, but life happened. We can't pay into the policy anymore, not even the minimum. So when we set up a policy, money can go where? Premium or into the PUA rider. The premium is the minimum piece. So perhaps life happens, we can't pay anymore. And I first say, well, no problem. You can easily commit to the minimum. Pay just the minimum premium and add more later. And you say, no, Steve, everything tanked. My company let everybody go. I can't pay anything into the policy anymore. What's going to happen to my policy? Well, what's important to look at here, and if you've worked with us or are working with us, you've likely seen this. When we look at the cash value, we do want to see what the values will look like based off of the present dividend rate, but then also a worst case scenario environment. Look at the guarantees, meaning if everything crashes and we lose our job, companies' dividend rates go down. Based off of the guarantees, will my money continue to appreciate, or will it go south and I can potentially lose everything? Then I really have a headache. So before we look at some numbers here, this is the most important piece. The policy design, critical. So you've heard us touch on the whole 1090 split. When we set up a policy, 10% of our payment can go towards the premium, 90% can go towards the PUA. Here's what I'll say. If life happens, especially early on in a life insurance policy, say we funded it for 2 years, if we had a policy with this setup, we'll be fine. If we had a policy where more money went towards the base premium, or we didn't fund it heavily with the PUA payment, we didn't come close to that 1090 split, maybe it was a 40-60, 60-40, something like that, that's where we can get into the trouble and the policy has to loan from itself or the values depreciate because the expenses outweigh the interest earned. So let's take a look. We've got several examples up here. What we will begin with is a 35-year-old male. This is a policy designed with a 1090 split with one of the 4 major mutual companies. Now, on the left, we have a policy where we've got life is good. We're going to assume he funds it from age 35 through age 65. No MEC occurs at any point in time. Cash values grow quite nicely, I might add. This is based off of the present dividend scale for 2020. Now, what we want to look at, well, firstly there, we broke even year 5. But what we want to look at is if life happens, meaning my original plan was to pump in $30,000 per year into the policy, but I can't do it anymore. The minimum base premium on this policy is $3,000. So the first thing, after 2 years, we're going to assume everything goes south, can't pay anything in. I say, well, you can easily pay just your $3,000 base premium. You, the policyholder, say, no, I can't pay anything in. Like, I've got to go on complete defense here for the foreseeable future. What's going to happen? Well, if we don't pay our premium here, the $3K is still due. However, if we have enough money in cash value, accruing dividends and interest, it can pay that premium for us. If you've heard the saying before, allow the dividends and interest to pay the premium for you, you can do that much earlier than many are aware of. So here's our cash value. And look at this. 0 out of pocket indefinitely. We're going to scroll down. Crossover point, just about year 5. 60 total has gone in, really just over the first and second year. And we've got 59 and change in year 5, and we're positive by year 6. That's with no payments going in. Now, one quick side note is if we wanted to reassume payments here, we can do that. So we can pick up payments, start funding the policy again. One thing we did here, when you see these death benefit reductions, we cut the term rider, then we executed a reduced paid up. What we're doing is if life happens and we really cannot pay anything in, as we work with you, if you're working with us or if you decide to, over the years, if we say, okay, we're not going to be able to pay anything in, we want to cut the insurance expenses, cut the term rider, cut the premium. This salvages the cash value and allows it to grow with, call it, less drag. So it keeps on growing. Now, let's look at an alternative scenario. We're going to look at a 45-year-old male. Now here, scenario 1, life is good on the left. We've got funding it heavily for 4 years, $50K per year. So this is a policy with a $50,000 MEC limit and a minimum premium. And then funding it with 18 a year thereafter. You see the cumulative outlay. There we go. So this would be a great example of someone with a lump sum, and then they start redirecting payments from another savings asset over to a cash value life insurance policy. This is fairly common. But what we're going to assume here, where we have a healthy break even and strong long-term performance between years 3 and 4, we're going to assume everything goes south after we get 2 payments in. Total of 100K, never pay another penny in. So you see my cumulative outlay never exceeds 100K. Look at my break-even point between year 4. The reason why is I got 2 payments of 50K in. After year 2, my minimum premium is still due through year 7. You can see that with the death benefit drop. So as that premium is still due, which is right around 5K, the dividends and interest are paying that premium for me, and my cash continues to grow. After year 8, we actually eliminated the base premium, so the cash value could grow with less drag on it. You see it pick up the pace actually over time. Point being, because the policy was designed with that 1090 split, we're in a position where our cash value continues to appreciate over time, and we don't have to worry about losing money. Now, this is based off of this particular company's 2020 dividend rate. Let's look at an even more exaggerated worst case scenario. We're going to keep the funding the same, but what we're going to do here is look at the guarantees. Exact same scenario, but assuming day 1, the policy only produces the guarantee of 4%. No dividends. So worst case scenario. And then we're going to look at the worst case scenario where we stopped funding. Again, what I'm looking at here is to see if my policy will lapse, if it will have to start loaning from itself, which if it's designed right, it will not have to. So based off the guarantees, well-designed policy, breaking even between 5 and 6. Perfect. Life happens scenario. Now, that premium's still due here. Based off the guarantees, what do you see? After we fund it, doesn't do much through year 7. Goes down a little bit. And the reason why, premium is still due, the insurance expenses, the base premium, and the cost of that term rider are exceeding the guaranteed rate of 4%. That's why I see my value decreasing slightly, $300, then $500, then $700. But then as soon as we cut that term rider, and the premium for that matter, starts to jump. There's my break-even point. Again, this is not super attractive, but what it shows us is in a worst case scenario, I can't pay and the company only pays the guarantees. My value does continue to appreciate over time, and I do not lose everything that I've paid in. There's my growth over time. So, main point, if the policy is designed properly, and if we are I always recommend consider one of the big four, the four major mutual companies. We can put ourselves in a position where in the event life happens, we're good. Our policy will continue to appreciate. We can decide to fund it again later if we want to, but we're not required to do so. Hope this helps. Reach out with any questions. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.